Welcome to our comprehensive exploration of The Intelligent Investor, the seminal work by Benjamin Graham, whose teachings have shaped the landscape of modern investing. This book is not just a manual on investing. It is a manifesto on how to approach financial decisions with prudence, discipline, and a sound intellectual framework. Did you know that since its publication in 1949, The Intelligent Investor has sold millions of copies worldwide and is considered the stock market Bible? It's the book that Warren Buffett, one of the greatest investors of all time, credits as the foundation of his investing principles. Join us as we break down the essence of intelligent investing, using real-world examples, and show you why Graham's approach is more relevant today than ever before. Whether you're a seasoned investor or just starting out, these insights will help you make informed, rational decisions that align with your financial goals. So, buckle up and prepare to transform the way you think about investing, one chapter at a time. Chapter 1. Introduction to Benjamin Graham and Value Investing. Welcome to our deep dive into The Intelligent Investor by Benjamin Graham, the Bible of investing and the definitive book on value investing. Benjamin Graham, often known as the father of value investing, introduced the concept that an investor should look primarily for safety and secondarily for profit. This means focusing on getting more than you paid for. Graham's teachings emphasize that an investment must be purchased at a significant discount to its intrinsic value, buffered by a margin of safety. This principle guards against errors in estimation and unforeseen market downturns. Did you know that Warren Buffett, one of the richest men in the world and a disciple of Graham, credits this book as the best book on investing ever written? Value investing isn't just about picking stocks at low prices. According to Graham, it's about being analytical, disciplined, and patient. It demands rigorous analysis of fundamental financial data to find stocks that are undervalued by the market. For instance, Graham loved to focus on stocks that traded for less than their net current asset value, what he called bargain investments. One of his most famous quotes encapsulates his philosophy well: investment is most intelligent when it is most businesslike. This approach turns the market's fluctuations into opportunities for the disciplined investor. By treating investment as a business, one can safeguard against major losses and increase the likelihood of achieving sustainable gains. Chapter 2. The Investor and Inflation. Inflation is an investor's silent enemy, but Graham provided timeless advice on how to guard against it. Graham was clear that a good investment strategy must maintain purchasing power. His approach, focusing on quality stocks and bonds, provides a straightforward method to protect against the erosion of inflation. For Graham, investing in companies with tangible assets and robust earnings at low prices was key to safeguarding against inflation. He particularly liked utility companies during times of high inflation because they have tangible assets and the ability to adjust prices with inflation, which protects profits. A surprising fact is that during periods of inflation, Graham advised against conventional fixed-income securities, which lose value as inflation increases. Instead, he championed stocks as a more inflation-resistant asset. This is because businesses can pass higher costs onto consumers, unlike fixed-income securities whose payments remain constant. Graham also suggested a strategic allocation between stocks and bonds, with at least 25% of one's portfolio in bonds to provide stability and income, and up to 75% in stocks to ensure growth and protection against inflation. This blend of assets is aimed to balance risk and reward effectively. So, how does this apply to you? By understanding these principles, you can develop a portfolio that not only withstands market fluctuations but also guards against inflation, ensuring that your investments grow in real terms over time. Chapter 3. A Century of Stock Market History. Benjamin Graham's view on stock market history was not just academic, he used it to frame his investment philosophies. Understanding the past is crucial for predicting future market behavior and managing investment risks. Graham pointed out that despite the market's unpredictability in the short term, it shows remarkable consistency in long-term trends. A key takeaway from Graham's analysis is that markets have cyclical patterns, periods of high and low prices driven by economic conditions, investor sentiment, and external events. For example, Graham studied market behaviors during the Great Depression and found that even during severe downturns, companies with strong fundamentals could survive and thrive. Graham emphasized the importance of looking at historical price-to-earnings (P/E) ratios, dividend yields, and other financial metrics to gauge market conditions. He famously noted that smart investors should be fearful when others are greedy and greedy only when others are fearful. This perspective encourages investors to seek opportunities when the market is down and be cautious when it's at all-time highs. One of the interesting statistical insights from Graham is that over the long term, stocks have generally provided returns of about 6–7% after inflation. This historical return rate is a cornerstone for investors aiming to estimate future returns realistically without falling into overly optimistic projections. Chapter 4. Defensive Investing. Defensive investing is ideal for those who prefer safety and a decent return with minimal effort and capability. Graham proposed several guidelines for defensive investing, which can protect investors from significant mistakes and ensure a steady income stream. First, diversification is crucial. Graham advised that no single stock or bond should make up more than a certain percentage of the total portfolio, typically around 5–10%. This strategy reduces the risk of any single investment's poor performance significantly impacting the portfolio. Second, Graham advocated for investing in high-grade bonds and dividend-paying stocks. For stocks, he recommended companies with a long history of profitability and strong financial stability, those that have consistently paid dividends for at least 20 years. Another strategy is to use dollar-cost averaging, investing a fixed amount of money into a particular stock or stocks at regular intervals, regardless of the share price. This technique reduces the risk of investing a large amount in a single stock at the wrong time. Interestingly, Graham was not a big fan of chasing hot stocks or trends. Instead, he believed in the power of patience and the discipline of purchasing stocks below their intrinsic value. This approach aligns with his principle that buying a stock to simply make money in the market extracts from the investor every ounce of intelligence he might have had. Chapter 5. Aggressive Investing. For those willing to take on more risk for potentially higher returns, Benjamin Graham outlined strategies that fall under what he called aggressive, or enterprising, investing. This type of investing requires more time, effort, and knowledge, but it can be highly rewarding if executed with discipline and intelligence. Enterprising investing involves looking for undervalued securities that the market has overlooked. These might include growth stocks, small-cap stocks, or distressed assets that are selling at a significant discount due to temporary problems. Graham stressed the importance of thorough analysis and due diligence to uncover these opportunities, which are often ignored by the majority of investors. One of Graham's strategies for aggressive investors is the net stock approach, where investors look for stocks trading below their net current asset value, NCAV, essentially buying businesses for less than the value of their current assets minus all liabilities. It's a strategy that has uncovered numerous bargains in the past but requires meticulous analysis to ensure that the company isn't facing insurmountable issues. Graham also suggested special situations like arbitrage or merger securities as potential high-reward strategies for enterprising investors. These opportunities often arise from corporate actions like mergers, acquisitions, or restructurings, where the securities of the involved companies might misprice. Despite the potential for higher returns, Graham never lost sight of the risks involved. He famously advised, "Do not let anyone else risk your money in ways that you wouldn't risk it yourself." This underscores the need for personal judgment and responsibility in all investment decisions, particularly when employing more aggressive tactics. Chapter 6. Portfolio Policies for the Enterprising Investor. For enterprising investors who actively manage their portfolios, Graham provided detailed guidance on how to construct and maintain a well-balanced portfolio. His advice was tailored to those who have the time and resources to dedicate to managing their investments more closely than the average investor. Graham recommended a diversified portfolio but with a greater emphasis on finding mispriced securities that could lead to substantial gains. This involves a mix of equity positions, fixed income, and possibly even alternative investments like real estate or commodities, depending on individual expertise and market conditions. For stock selection, Graham favored companies with strong financial positions and above-average earnings stability, but whose stocks were trading below their intrinsic values due to market inefficiencies or temporary setbacks. He also advised having a significant portion of the portfolio in a variety of bonds to provide income and reduce overall volatility. Another key element of Graham's strategy for enterprising investors is the concept of market timing, not in the conventional sense of predicting market movements but in adjusting the asset allocation based on the general market valuation. For instance, reducing stock exposure when the market is historically high and increasing it when the market is low. Lastly, Graham believed in active portfolio management, including regularly reviewing and rebalancing the portfolio to maintain alignment with one's investment goals and risk tolerance. This proactive approach helps capitalize on market conditions and individual security performances. Chapter 7. The Investor and Market Fluctuations. Understanding and leveraging market fluctuations is a key element of Benjamin Graham's investment philosophy. Graham advised that the intelligent investor should not fear market fluctuations, but rather use them as opportunities to buy undervalued stocks or to sell when stocks become overvalued. Graham differentiated between investor and speculator. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. Market fluctuations are significant to the investor because they provide him with opportunities to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. It's not about trying to time the market perfectly but about making informed decisions based on value. A fascinating aspect of Graham's approach is his recommendation to always have a balanced perspective towards market prices. He introduced the concept of Mr. Market, a hypothetical investor who is driven by panic, euphoria, and apathy on any given day and offers to buy or sell shares at different prices. The intelligent investor is advised to ignore the manic depressive nature of Mr. Market unless it serves their interest. Moreover, Graham stressed the importance of having a clear policy of how much to buy and sell. For instance, by setting price targets at which to buy or sell stocks based on their intrinsic values. This disciplined approach helps investors avoid the emotional pitfalls of the market's ups and downs and stay focused on long-term goals. Chapter 8. Investing in funds. Mutual funds, index funds, and other pooled investment vehicles are a significant part of the modern investor's toolkit, offering diversification and management expertise. Graham recognized the value of funds for both defensive and enterprising investors, but he also cautioned about selecting the right type of fund. For defensive investors, Graham recommended mutual funds as a way to achieve adequate diversification without the need to engage deeply with financial analysis. He particularly endorsed index funds, which track a market index and typically come with lower costs and fees than actively managed funds. Graham appreciated the efficiency and the reduced risk of manager bias in index funds. For the enterprising investor, Graham pointed out the potential in specialized funds that focus on sectors or strategies that might be more volatile but offer higher returns. However, he warned that such funds require more diligence in selection and ongoing monitoring to ensure they meet the investor's risk tolerance and investment goals. Graham also highlighted the importance of understanding a fund's fee structure, its track record, and the reliability of its management. He famously said, "While enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster." This serves as a caution against following fund fads without a clear understanding of their underpinnings. Chapter 9. A practical approach to Graham's philosophies. In this final chapter, we'll explore how Benjamin Graham's investment strategies can be adapted and applied in today's investment environment. Despite the changes in the financial markets since Graham's time, the core principles of his investment philosophy remain incredibly relevant. Graham's approach to value investing involves continuous learning and adaptation. Today, investors have access to a vast amount of data and sophisticated analytical tools that Graham never had. Using these tools can enhance traditional value investing techniques, like fundamental analysis, to identify undervalued stocks more effectively. Moreover, Graham's principles of looking for a margin of safety and investing with a defensive stance are particularly pertinent in today's volatile and often overvalued markets. Investors who apply these principles can protect themselves from significant losses in market downturns. An interesting application of Graham's theories in today's market is the use of quantitative value investing. This involves using algorithms to apply Graham's criteria to large datasets to identify potential investments, blending traditional principles with modern technology. Lastly, Graham's advice on behavioral finance, specifically, his warnings against speculation and market psychology, are more applicable today than ever. With the rise of social media and real-time news, investors are often swayed by herd mentality and market noise. By adhering to Graham's disciplined, value-focused approach, investors can navigate these challenges more effectively.